A year ago, all the talk was about inverted yield curves and fear of recession. And I remember you said, in fact, that the biggest fear we should have is the fear of recession, that's what could hold us back. So look back at 2019. What happened with the U.S. economy over that year?
It wasn't a year ago. I think it was 4 months ago. And so the idea was the economy was slowing down, and the question was, could people be assured it wasn't going to keep going? And that was the debate that raged during the middle of 2019, and the yield curve inverted and other things went on. And the worldwide slowdown was another aspect. So we're going from 3% growth rate to low twos, 2.3, 2.2, whatever it'll end up being, with a 1.7 is our estimate for next year. So the debate was, okay, it's slowing down, but will it not keep slowing down? And it was clear that that wasn't the case, but everybody was starting to talk themselves into that was the case. Then you added into it a couple major geopolitical discussions going on, but think about it, just in the last 4 months, really, you've seen things resolve, even though we had something that people say would affect it, which was impeachment. It hasn't changed the view of the market and the view of growth, and that comes down to the U.S. consumer.
I want to talk about the U.S. consumer, but we also had 3 rate cuts from the Fed. How much did that help sort of slow the decline? Well,
I think, as the Fed said in their minutes in their discussion around this, it was about insurance to put a little more accommodation in the economy to make sure that decline in growth rate bottomed out, or at least projected to bottom out, or people thought it was going to bottom out. And what you've seen is, as you've looked at the statistics, whether it's today's confidence numbers, they've all started moving back a little north. They've started moving back in favor. Still a little tough on the institutional side, the commercial side, in terms of there was a true inventory recession in the first part of the year, so that classic sort of working through the trade issues. But on the consumer side, the strength. But I think the Fed's moves gave the confidence that they're ready there to put that insurance policy on the table, and it appears to be just enough right now.
Well, the Fed seems to be indicating they're probably going to stand pat unless things change through 2020. Do they need to keep cutting to keep the growth going?
I don't think they do, because the consumer. And so when we look at the consumer, last time we talked, we were talking about the year-over-year growth rate for consumers through that period of time being 5.8%. It still is. It's closer to 6 now. The holiday spending is up double-digit from last year through last Friday, so you're seeing it now through the Cyber Monday, and you'll have great discussions with people about how many days there are between Christmas and Thanksgiving, but even halfway through the period, more or less now, you're seeing the growth rate at 6% year-over-year in the credit cards, but almost 10% overall. And so there's a lot of other spending going on, cash and other things. So we feel very good about the consumer in the U.S. And if that's 2/3 of the U.S. economy, it's as big as China's economy. Those are big anchors. And by the way, in Europe, the consumers are spending also. So you put that together, that's a big part of the world's economy is solidly moving forward.
You have a vantage point into the U.S. consumer that maybe no one else has. Very few have, that's for sure. When you look below the top line numbers of the consumer, do you see any overperformance, underperformance, either geographically or socioeconomically? Is it distributed evenly?
Well, I think what you're seeing now is the wages are growing, especially in the median income area and lower, growing faster now, which is good, because that's, if you go back to what the Fed was trying to do, they're trying to make sure that the tight labor market translates to people's income growth. And that's been consistent, frankly, from Chair Yellen to Chair Powell, the same thought process, and you're seeing that happen now at an accelerating rate. And so that is a good thing, because that means there's more money to more people, and more people are spending it. So that's a good thing. And so that insight you see, and you see that translate into broad-based spending. And there's a little bit of difficulty always about spending on things versus spending on experiences, going to do stuff, going out to dinner, and you're seeing them both remain strong with additional emphasis on experiences and electronics and things that are not necessarily a car or something like that, but are things that people can consume and like.
From what you see at Bank of America, can we keep this going with respect to the consumer specifically? Because typically economists say you either have to have more people working or you have to have a higher productivity. We're not getting a lot more people working in terms of the overall population size, and productivity growth is not as robust as it has been.
Well, this is a great question. You're kind of in this nice equilibrium where job growth is enough to more than absorb the population growth, which then brings people in the labor market, and you're seeing the participation rate inch, and you're seeing the underemployment rate keep coming down, and those are all good things. And if you hear the experts talk about, there's still a lot of potential slack out there. There's still a lot of people who could work that we're pulling back in. The question long term will be, you'll run out of those people at some point with an unemployment rate of mid-3s and maybe going further south with a underemployment rate coming down also, you will start to run out of people, and that's the question about immigration, getting a bipartisan structural thing that feeds the immigration issue into a population growth and economic growth issue and away from the other types of things it gets tied up in.
Are we seeing the capital investment that we need for productivity? You mentioned that business investment is a little softer than what you're seeing with the consumer. What are you seeing in terms of business investment?
Well, if you think about 18 business investment as a comparison year, because of tax reform at the end of 17, you had a fast acceleration. The good news is some of the extenders and things that are needed to keep that going are out in the past, it looks like. And so you're seeing the economy come together, so it's growing at a slower rate. Businesses spend a lot fast because when they get the chance, they spend it. That slowed down. Now you have a new run rate. I think it's going to be solid from now on. It just won't grow at the same rate it grew coming from 17 to 18 when you had that sort of immediate rush of the benefits of the taxing and the deductions and the expensing and things. But that's still there. It's just once you do it a lot, you have to kind of let it absorb. And so you have this kind of, that goes back to sort of equilibrium of a 2% growth rate in the economy, population slightly growing, spending growing faster than that, jobs, wages growing, jobs growing. That's a good thing that implies a longer term runway ahead than I think people would have thought this summer. They thought we were coming perilously end of the longest recovery ever, and now people are sort of saying, yeah, there's no issue in 20, maybe no issue into 21. That's a change. That's a big change from where we were 4 or 5 months ago.
Big change, I should say. You also have obviously some very, very big banking clients, but you also really deal with medium-sized and smaller enterprises across the country. Do you see a difference in the capital investment patterns across the size of the enterprises?
If you think about a pyramid of small number of very large clients to the broadest base of small business clients, the 9 million we have, and the 30,000 middle market clients in the middle, what you really see is sort of inverse to that, the impact of global trade and those types of issues on them. So the people who are $30 million, $20 million, $15 million, $1 million revenue companies are fairly exposed only to the U.S. economy, and therefore they're not sure why all this debate's going on. But as you come up to the larger sized companies who by definition are involved in either the supply chain coming into them, selling goods outside the United States, somehow involved in the global economy, the worry about China's slowdown, the worry about other things going on affect them more, and that caused them to be a little more careful during the middle part of this year into the fall. We'll see what happens as nothing went wrong, we didn't see a recession as we come into next year. But people are setting the budgets, and we'll see how that comes out. And
we seem to be moving toward some sort of a deal, a limited deal with China.
Yeah.
And also, we now have ratification, at least in the House, of the USMCA, that successor to NAFTA. Are you seeing any indication yet in the C-suite they're saying, okay, now we have a little more certainty, we can plan a little bit farther ahead, we can invest a bit more?
Well, I think the 3 or 4 issues that sort of had to get resolved, USMCA, China trade, the budget, the government not shutting down. You remember last year we were sort of in the middle of discussions like that. That's sort of all resolved, and that's very good. Now you have this other, obviously geopolitical issue or U.S. political issue on impeachment that's different, and that is in a status, and we'll see what happens with that. But I think if you asked a CEO, 3 or 4 of the things that they were really worried about have resolved in a reasonably predictable way. Now, the China deal is still not announced and out there so people can assess it, but everything else has fallen into place.
You mentioned impeachment, and I must say, if you just watch the financial markets, it's really hard to see any reaction at all from the financial markets. You talk to a lot of CEOs, a lot of business people across the country. Are they reacting to it? Do they regard this as an important thing for their business?
As citizens, this is a very serious and important thing. And as I tell people, we've been around for all of them, and everyone that's occurred in the company's history, and we're still here, and the country's still here, so something will happen, and it's not, but businesses don't try to control things they can't control. They try to react to things that are out of their control and drive the things they can control. And so when you talk to CEOs, it's going on. They'd love for it to be resolved and not going on because it'd just be one less uncertainty, but everything else is falling in place, and they've got to keep going out and winning in the market. So it's as citizens, they're very concerned, but as business people, they're not seeing the impacts. They're just out there doing the business.
How much of the growth and even the confidence, consumer confidence or business confidence, is being driven by asset values? Because we still have interest rates that are very, very low. I mean, it's a very accommodative policy out of the Fed, and certainly worldwide. Right. How much was just we have inflated asset values, maybe overly inflated?
Well, if you ask the experts again, over the course of the fall here, you've seen a bit of a change in that too, that people are now, our experts think there's room to run in the market. Andy Sieg was out talking about that yesterday. And so if people think the earnings are continuing to grow and the earnings continue to grow, the stock market continue to go up, everybody's always worried about where the bubbles are, where the excesses are, and leverage and everything else. But if you actually look at it, our economy in the U.S. has gone from 14 trillion to 20 trillion across the last 12 years. And so a lot of this has grown with it, and if the earnings are there, it'll be okay. So it's really going to come down to chicken egg. The recessionary environment will cause the retraction in the earnings cycle and into the market valuations, and we're not seeing it yet.
So you're confident, you're an optimist, you know a lot that gives you cause for optimism. At the same time, you're a great risk manager, and any great risk manager is thinking about, okay, what could go wrong? Let's assume for the moment that the economy doesn't do as well over the next 12 months as we anticipate. What would have been the cause? What are the things you're looking at to say, that's what I would pay attention to?
In the end of the day, in the U.S., it's going to be driven by the U.S. consumer losing confidence and stopping the spending, and by companies reducing their hiring. And with 7 million job openings, whatever the exact number is now, they're just out there filling those jobs. And so that's the leading indicator you look for. New claims for unemployment, job openings, anything that says a person, a working person, thinks they're going to not be employed and not have as much money to spend next year and not be able to take care of their family. That's what you look for. And those indicators are, you see people talk about WARN notices, all these things, and none of them are problematic right now, but that's what you look at. You won't see it in like credit card delinquencies until the people pay you. I mean, they owe their debt, they pay it. The reality is when they lose their job, they can't. And so until those are all lagging indicators. So you're looking at what's going to affect their job status more than anything else.
You are presiding over a big transformation, not just of Bank of America, but of the banking sector in the United States. And a lot of that's digital. Talk to us about Erica, exactly, that financial digital assistant, I think you call it.
Well, I think you have to back up into the broadest context of all this, which is the customers' behaviors change dramatically. So we have 38 million digital customers, almost 30 million mobile customers. The difference between that is somebody uses something other than a mobile phone or an app. And so if you think about that basic question, which was probably 5 million 10 years ago of mobile customers, and just the implied usage and implied things people do with it, not only in their daily life, but in their banking life, Erica is a natural extension of that, which is now with voice recognition and the artificial intelligence and the systems architecture and the customer's willingness to do it that way. We have 10 million Erica users, and it's very easy to use. You just talk in it, pay the piano teacher, and it'll pay the piano teacher. It's pay tuition to whatever university your child's going to next year. It'll pay the tuition for you. You'll find it. Get all the payments to XYZ electric company. It'll pull them all out. It'll tell you where you are in your FICO score, your financial plan. It's a great tool for people, but the real advancement was the voice recognition that we built with Stanford and others, that we had a natural language program, which was key because you had to be able to have that work in the context of banking and financial planning.
So as you connect that with growth, future growth at Bank of America, how much of that is top line, if I can say that, and how much of it is the margin?
Sure.
Because it may be you're just getting people to use the services more, top line growth,
right.
Or it could be it's more efficient, because I've heard that it's much less expensive for Bank of America to really handle an account online than it is in a branch.
So we've been at this now, Erica's 18 months old, but if you go back to the branches to ATMs, ATMs to phone, branches to phones, phones to ATMs, ATMs to digital technology, computer-based banking, and to mobile phones. So this has been a massive transformation. And so in the last 10 or 12 years since the entire franchise came together, what you've been able to see is us go from 6,100 branches to 4,300 branches with about 1.5 times the business. That's been enabled by the customer's usage pattern changing dramatically. So you never want to be ahead of the customers, never want to be ahead of the customers. So it's a top line in that we have 1.5 times as much deposit base. And it's a bottom line in that the cost structure is down about 50% in that time frame. And so you're leveraging on both sides. Meanwhile, we've also had to observe a much lower rate structure, which from last decade to this decade, that also costs us a lot of revenue. So you put that all together, and so you have good profitability in consumer bank, but the way you made up for some of the rate challenges was you were able to take out the costs.
How far can you ride that horse? I mean, how much can you grow the deposit base because of digital, and how much can you take out of the cost?
Well, you need high touch, high tech. This is the other firm belief we have as a company, which is between today and tomorrow, or at this time, 800,000 people go into branches, teammates will serve them. So you need both things. So you need the branches and you need the digital. So you don't know where it ends. You don't know where it goes. So we had no ability to do digital mortgages probably 2-3 years ago, and now 40% of them are that way. You had no ability to do digital car loans, and now even a higher percentage of them. You had no ability to do mobile check deposits till 2011 or 12 or whatever it was, and now 25% are done that way. So you're always working that question.
Can you see the ceiling?
No, you can't, because it's customers, it's behavior, it's what you're going to do. If you tell me what you're going to do, for 5 years from now, exactly how you behave with your mobile phone for banking, I can tell you what the answer is, but we're going to let you decide that.
You're growing your revenue base. You're growing your deposit base. Strike that. Forget it. You're growing your deposit base. You're getting bigger in your assets. Yeah. How much bigger can Bank of America get? Because you're pretty big right now.
What determines our size is our success in the deposit side, both for people, individuals, companies, and even a larger enterprise. Because at the end of the day, we have more deposits, $1.4 trillion, than we have loans, $950 billion. So that's what determines our size. So we'll be as big as we can do a great job with the customers in the United States on both the commercial customers and the consumer customers and how they drive. We don't need to be the biggest bank. We need to be the best bank.
And can you make up for the low interest rates? Because Bank of America is particularly sensitive to interest rates. Yeah. Can you make up for that sort of headwind with the tailwind of bigger deposits?
Well, we've done it. It was easier when rates were going up, but if you look, the team's been running the business now for 10 years for me, and they're a great team, but 70% of the time, the Fed funds rate was 25 basis points. It hadn't come up from 15 to 18, now it's come back down. So their ability to operate in any environment is very strong, and so I have great confidence in them. But it took that discipline to say, simplify from 20 checking accounts to 4. I don't know how many credit card products we had, to simpler numbers, to get rid of products that weren't important, to introduce more and more relationship management in the branches, then to introduce and drive the usage, to your point, of the digital technology. You put that all together, we have the most efficient consumer business and the biggest business in the United States by about 15 or 20% in consumer retail banking, and that's a powerful thing. And so they've been able to manage through all environments. It would be easier if the Fed funds rate was 2.5 versus 150, but that's not my choice. Yeah,
it doesn't look like it's going there either anytime soon.
But if it's not there for the right reasons, that's terrific. And so when you think about it, if we can have a 2% growth economy, and we'll grow.
Talk about trading. With the investment bank, we talked about the investment bank. There was a time when you thought you needed to make some changes there. You made some changes, and you continue to make them. I think you just appointed a new head of EMEA for investment bank. Where are you in that process? How far are you? 50%, 75%, 100% of the way toward the transformation you want?
So if you think about investment banking versus trading and sort of corporate investment banking, working with large companies to do what they need us to do for them, whether it's lending them money, transaction services, debt capital markets, equity capital markets, M&A advice. About a year ago, we put Matthew Coder in over top of it, working for Tom Montag, and he's done a great job. You've seen our market shares increase. Again, we aren't satisfied with being, quote, anywhere. We will get better every day. We'll more clients, do more for those clients, serve them better, bring them more ideas, and just keep driving it. It's a big business for us. Our global banking business makes about $1 billion a quarter. It has a great efficiency ratio, great return, and Matthew's done a great job. But where you and all your colleagues see it is you see the M&A and lifting market share, but the reality is that the business is a huge business, of which that is one component part. So we've done a great job there. We've done a great job in capital markets, but what he's really done is a great job across the board.
And you were trying to drive that through middle market more. I think you thought that it was an advantage of Bank of America. Is that working out? Is that happening?
Yeah. And so you're seeing Alistair Borthwick runs our middle market business, 30,000 customers, and does a very good job there. But the capital markets business out of that segment's growing by 30%, so debt capital markets, some equity capital markets.
Year over year, 30%?
Yeah, and then an M&A advice, and they've done a great job, but we're adding more people to service that client base. And so the goal is to cover more deeply into the segments based on our historic strength of that middle market base. But again, that business is, again, loans, deposits, transaction service around those deposits, and all this, and you can't focus on any one thing, because as big as our company is and as good as the team is, they've got to get it all done, and that's what we you can't make or break this on any one product or aspect of it.
On trading, you've said that your trading is up year over year at this point. Is that because you're just doing better trading, or is it because the markets have really been more conducive to trading?
You know, last December was pretty wild. I mean,
I remember
it forgets that, you know, literally in the first week you thought you're okay, and then it went south. But the team's doing a good job, and they're managing the risk well, and you know, they take a lot of risk, which they should do for their clients. They don't take it on their own; they take it for clients, and they help them do it, get access to the market. So we've been very pleased with the work Jimmy and Fab and Bernie and others are doing in trading.
Let's talk about private credit. There's a lot of money out there right now looking to be placed somewhere, and we have the Blackstones, we have the Apollos and things who are moving into some of the larger deals and making some really big loans that I think historically Bank of America might have made. Do you see them as a competitor?
You know, they're clients and they're competitors. For a given deal that they might do a structure, that might be a competitor, but they're major clients of ours too. So there are all kinds of people competing in this business, and I've never, you know, at our size, our scale, our scope, and our talent, we should win.
What advantage do you have over them? What advantage do they have over you?
We have 30,000 middle market clients that got to get to market, you know, several thousand large companies around the world, a global franchise, and then the expertise just to, you know, do deals and get them underwritten that they utilize all the time. And so I think that's our competitive advantage. You know, the asset class sort of thought process and everything is an important trend in the business, and we pay attention to it, but that's part of, you know, we work with those clients too in terms of moving positions they want to move and everything. So you're working with these firms as partners, and yeah, on a given deal they may do a tranche of financing that we'd have done, but typically they're doing a different tranche, honestly, and so we're more focused on the shorter term revolvers and how we finance, and they're more focused on some of the term finance. There's
competing for business, there's also competing for people. Yeah. Are you competing much more directly for talent?
Oh, that's been going on for years. I mean, that's, you know, it's a robust talent business that we have here. If you look out and see these talent teammates, we've all been competing for the best top talent out of the best schools, and you know, that's one of the things I've been proud of with the team. You know, in the last 10 years, we probably hired, I don't know, 25,000 kids out of school and provided them great training, great careers. A lot of them work for those clients, which is absolutely fine with us. And so, you know, they'll work for us for 2 or 3 years, they'll go back to business school and end up with one of those clients, and that's great. But it's, you know, we never cut back on a hire, and we kept hiring people, and it's been it's a testimony to the team and bringing those colleagues in, and a lot of them are still with us.
Leveraged loans. You're at or near the top of the league tables in leveraged loans. At the same time, a lot of people, I think you included, have expressed some concern about leveraged loans. Explain what that concern is and how you manage to it.
Well, the actual exposure on your books is relatively small, especially given the size of our loan book. And so if you go way back, you know, we have balanced the company, commercial consumer lending, secured lending on the consumer side is a bigger part than the total lending book, and then on the commercial side, sort of the traditional underwriting, keeping commercial real estate. So that's how you manage risk. When you go back to the question earlier about, you know, what could go wrong, we view everything could go wrong, or anything could go wrong. And so you manage your risk by having diversification and thinking about it and client selection. When you think about leveraged finance, we've always been very good at business. It's not necessarily on our books. But the question is, over-leveraged companies tend to have problems when the world slows down. That's you know, economics 101 or credit underwriting 101. And so we have to underwrite them with the right amount of debt turns and other things. And so you hear us get concerned when the market moves away from the traditional sort of levels that the major financial institutions to find higher levels through other providers. We get concerned about that because it usually reverberates back at some point. And so the real concern is there too much leverage in the system in certain companies, and if they have trouble, will that impact the economy? That's the question on the table that you're hearing people talk about. The actual, they're held in funds with net asset value, and the fund will go down in value, and that happens all the time. But the question is, is it enough of a market share that will actually impact the economy? That's the concern you hear more about.
With the cost of borrowing where it is, we still have a lot of negative interest rates out there, with an awful lot of debt. Isn't it inevitable that people will borrow too much? It almost compels them to. It's sort of, you know, it's almost free, or better than free. They'll pay you to use it.
Well, whether it's the federal government, the state governments, or people, or companies, you always worry about, at the end of the day, when you go back and look at all financial crises, excess leverage is the thing that you know, usually tips them over. What has been interesting is when people are talking about like the biggest asset class for consumers, the home, has been very well structured for a long time now. And while the economy has grown around it, by, from 14 trillion in size to 21 trillion, and the earnings power, wealth, et cetera, et cetera. You've seen the home mortgage loans totals just barely get above where they were, and they're quote record levels, but as a percentage of everything you think about over 15 years ago, you could see how inflated they were if they're only getting back there now. So we feel that the mortgage structures are good. We feel the credit card lending structure in the prime business is good. We feel the auto in the prime business is good. So you don't see, even though the volumes are high and the low rates allow the servicing to be lower, and which is the reason why the Fed uses low rates, because it stimulates the economy and central banks around the world. The reality is that it's always a question of how many debt turns a company can have, and that's why we try to keep them to our underwriting standards and try to bring the market to that. And on the consumer side, it's the same thing. 760 FICO for our home equity, 70/40 or something for our credit cards. These are prime borrowers that we're very comfortable with our credit. Doesn't mean there might be other people doing something different, but we try to stick to our knitting.
What's the biggest opportunity for Bank of America for further growth at this point? And is it geographic or is it a particular product line?
Well, the biggest opportunity is really continuing to drive more relationship managers. In the United States, where we do all the businesses, it's more relationship management capacity in all the markets we serve. And that's why we're building out markets and adding people all over the United States, because by the happenstance of how we got to be where we are, we're not in certain cities. We weren't in 7 of the top 30. We're now in 3 or 4 of them. We have a few $2.7 billion deposits in Denver and a like amount in Minneapolis, starting from scratch 3 or 4 years ago. So we're building out these cities underneath our Merrill franchise, underneath our commercial banking franchise, with a retail franchise. So the big opportunity is to actually, the way we look at it is we think our best market share in a market should be replicable in every market. And sort of why not? With our capabilities, our brand, and that means you just keep adding relationship management capacity. In the global business, it's corporate investment banking and markets. And so in markets, we're basically in all the major training venues, and we're always looking at that. Is there any place we need to be? And then corporate investment banking, it's a similar thing, adding more investment bankers and corporate bankers to cover more clients with more depth outside the United States, and we keep adding them 2 or 3% a year and grow the business, and then invest in the treasury services. And so there's great opportunity everywhere we look, but it sounds so straightforward, but to actually accomplish that across I think we have 60-some thousand relationship management people in the company. So you're growing that. So think about adding not only your attrition rate, but 3 or 4% on top of that, and think about getting all those people effective, and think about getting them all deployed, and think about getting them all to go after clients. And that's the what we call the flywheel you turn. And on the edge of that flywheel, you see a lot of good things.
But take one of those investment bank. You mentioned you've added people in investment bank. Are you saying you anticipate adding net an additional 2 to 3% a year going forward as far as the ICs?
Unless you believe your teammates aren't working hard, and our teammates work very hard, I can't grow unless I add capacity. And so in the pure digital world, I can add capacity without human beings, but that's really a limited applicability in 1 or 2 businesses now. The rest of it, it's really about relationship management, and people want to meet with people. So if you're a $10 million revenue company, and we got to have more relationship management bankers to go out there. And so, and even in the branches, we've, over the last 10 years, I showed the other day, we've gone from 90,000 people to 60,000 people, but the number of relationship management people has gone from 17 to 25. Right. And so you're expanding that. By the way, digital sales were not even there in 2010, and now 35% there, so 40%. So you start to see that capacity is on top of the people capacity, but you had to add all those people, because at the end of the day, you need more relationship manager capacity to grow the business. And that's a growth mindset that it took a while to squeeze into the company, because if you're doing deals all the time and you're a commercial banker and I'm a commercial banker and I get to choose one, it feels good, but we don't have that. That's not going on anymore. What we're now doing is, I'm a commercial banker and we need another commercial banker in Columbus, Ohio. We have to add a person and hire them, get them up to speed.
But you made the point, if you look at the overall population of Bank of America, it's not going up really at all. You're really managing the cost. So if you're adding that many relationship people, that means it's got to come out of somewhere. Where's it coming out of?
That's the hard work we call it operational excellence, which is about constantly investing in the efficiency and effectiveness and the digitization, the application of robotics and artificial intelligence and all the things you hear people talk about. We do it. So when I became CEO in 2010, we had about 288,000 people. We went up to 305,000 people, and now we're about 208,000 people. And in that capacity, we've added salespeople And in that capacity, we've grown the company, and that's all by just constantly working. And all the different things, it takes years to get some of this out. People think you can snap your fingers, but it took us years to get the digital platform up to enough that it actually had an impact to consumer. It took us years to get the branch configuration done. It took us years to invest in the new branches to give us a relationship management capacity so we could actually reduce the branch count. And so all this is just good work by the team, and they've been at it. And so a lot of people think you can snap your fingers and transform a company. When you have this size, $90 billion in revenue and stuff, you just have to work at it every day.
There's a lot of talk in business community, but around the world right now about the future of capitalism. Is capitalism doing what it should be doing in the way it should be doing it? And it gets translated into things like the role of the corporation in society, in the community, ESG, environmental, social governance. I know this is something very important to you. You've been very active in. Let me start with the definition first. How do you think about the issue? How do you define it?
When I define how we operate within that framework, it's basically what we call the genius of the and. The great Jim Collins wrote this thing, and he had it years before people started talking, which is you have to produce for your customers, your teammates, and your shareholders. And you have to produce for society. Because if you don't have and, if that's an or, I won't be sitting here. Because I've got to deliver, the team's got to deliver for all those things. So that's the way we think about it as a company. It's that genius of the and. Can we do both what our customers, clients, and shareholders need us for, produce returns that are second to none in the industry, get more in our cost of capital, deploy more relationship managers, bring our customer experience up during that whole time, and do the volunteer work and the charity work and the low and moderate income investing and housing work we do, and drive the whole company towards these goals. That's how you think about how we think about it as a company. When you put it in a broader context, it's really a stakeholder view of capitalism. So whether it's what Klaus Schwab has been working on the World Economic Forum for 50 years, it was a view that you had to think about society and not just about share return. What the Business Roundtable did with Josh and Jamie and Alex and others is basically modernize our statement, because quite frankly, most of the people are running their companies this way, but when you talked about it, people said, well, your biggest business group, statement says shareholder maximization is the only thing to think about. And from 1996, and then we just were modernizing, given the way people run the companies. It's not, and if you look at the companies at BRT, they perform well. So it's not an excuse to try to do something else. It's a modification of capitalism and the discussion about it. But it's a trend that's been going on for years. And frankly, in our particular industry, we came out of the community. And I remember writing my first strategic plan in 1993, and somebody chastised me because I didn't talk about the community and that as a strategic planning head. And I was like, wait a second, shareholders, customers, teammates, what do you mean? And they said, well, you have to remember a bank has a special role. So the banking industry has been part of this for a long time.
It sounds wonderful, but it's harder to do in practice than it sounds. I mean, the and sounds fun, but there are choices where it's a zero-sum game. Right. You take away from one, you give to another, and vice versa. How do you reconcile that? I mean, you're a CEO. Any CEO has to weigh sort of shorter-term profit maximizing earnings against really fundamental change. How do you reconcile those two?
Well, the definition of this is long-termism and things that Larry Fink wrote about a few years ago. They're all various expressions of this broader constituency and thinking about the broader impact of what you do over time. And so, as people are thinking about these things, I've tried to. Our team asks the same question. So what are you really telling us to do?
Right.
And so you can describe it. The genius of the and. But the question is, what does it mean? So you have to think about. Take the environmental one, which is a way to think about it. We are carbon neutral by next year. You're hearing energy companies declare the date they're carbon neutral by. At the World Economic Forum's and National Business Council, we're trying to get an inventory and get everybody who can declare a date. And once you declare that date, what does that really mean? That means you have to change the way you operate from now to that date to get there. Mm-hmm. And so for an energy company, it's really important because that means they're changing their business model. For a company like ours, it means you're changing how you consume energy. You have to buy offsets, and those offsets go to do other things to help the program go. In our case, we also have our financings and other things we do. But if you think about the first is how you operate. So universities can declare a date they're carbon neutral by. I think anybody can do it, and I'm not saying they can do it tomorrow, but if you declare that, what that does is cut the whole energy delivery stream, which is really what we got to change. We'll change towards that over time because the consumers, us, will be demanding, I need more alternative source of my energy because I can't keep paying for the offsets. Mm-hmm. And I'd rather pay you to get it done and pay the offsets. And so that's how you think about it. So first is how you operate. And so this building is a LEED Platinum certified building, the first one ever done at this size. And so what that means, the energy consumption is a lot lower. The other thing is how you consume, printers and all this stuff, and lights and everything you're doing, all that. We also think about how we drive the environmental goal, SDG, by our teammates get hybrid cars and credits for that. We also think about the $300 billion environmental commitment we've now made for the next 10 years after completing $125 billion, including a record amount of activity this quarter that I told people.
And that's to finance
other
move
people's
to new energy.
Right. And so what that's doing is, if for company A that says I'm going to be carbon neutral by a date, they've got to go out and invest in that change. So if it's a power company, we're doing green bonds to help them raise the funds where people will give them a lower interest rate because they want to push them along. And so when you think about the environmental, it's not only every company operates and has an environmental carbon footprint or whatever the word people use. Everybody's got to get that in order. That then builds money, pressure, and a change in energy supply. And the U.S. can move fast. I mean, just in the last 5 years, we've gone to where coal is depleted, gone down below alternatives, and that's pretty good. And then we've got to get everybody going. That generates real money, because that's the real question. The question is, you can't do it without capitalism, and that's what people have to understand.
If you're going to manage to that, you have to measure it.
Yeah.
Is there a standard, for example, carbon neutral,
Yeah.
from company to company, sector to sector, country to country, where everybody agrees what carbon neutral is? Because with financial standards, you've got generally accepted accounting principles, and if you fudge on those, you'll get in trouble.
Right.
Do we have standards that we can measure?
There's a definition, a set of standards. There's some in Europe. One of the problems is a proliferation of way people want to measure it. And another work that's going on, we're trying to drive a standardization of the standards and not keep adding more and not keep adding different ways to define what the outcome of capitalism we want. So there are standards, there are methods. And by the way, in the near term, people are going to have to do offsets. And there's a validity offset production and things that it is tested, and it goes to organizations that deploy it to do good work, and that's good because more money deployed to that does more good work and stuff. So there are standards, but one of the things is there are becoming too many standards, and there's 600 sustainability conferences I read someplace over last year. So there's a lot of people. The question is, companies like us got to do it, because at the end of the day, the point is, if capitalism doesn't do this, it isn't going to happen. All the SDGs are $6 trillion a year in cost. The current amount going.
This is Sustainable Development Goals from the UN.
Right.
Yeah.
They think about a third going in, something less than that probably. The U.S. government budget is $4 trillion. So it can, and it's running a $1 trillion deficit. So there's only so much the U.S. can do, and all the other countries in the world are in the same constraint. If you go to all the charity in the world, it's $800 billion a year. That isn't going to bring enough money. And if you go to all the endowments, and everybody says take the endowments and use them, it's $1.5 trillion. So there's just, the only way the money's going to come is by everybody doing a lot, a little, then a lot, and that will add up to a lot. And that's by companies, how they operate, and by financial institutions, how we finance the change. And then it's also a business proposition, because think of all those companies. We did a bond for utility in Europe that the rate went up if they didn't half the delivery of their power was through alternative means. We did another revolving line of credit that the rate was lower because it was going to go for green purposes. These are things that you're just matriculating on each other will build up the big thing. But that's the only way you can get the much money, because you want our $53 billion expense base working on it, our $2.4 trillion balance sheet working on it, or do you want our charity, which is only $200 million a year, working on it, even if it all went there, and then there'd be a lot of other disappointed people.
You're clearly very devoted to this. You're going to do what you can to get it done. Not every CEO necessarily is. Who holds companies accountable to what they say they're going to do? Do investors at this point, will people disinvest if they think you're not measuring up to what you said you would do in this area?
Well, that's another sort of practice that's developed and fairly robustly now, which is, think of us now as a major investor with Merrill Lynch, the private bank, and then and what you can do with our pension plan stuff. And so the practice of ESG investing, or aiming the money to the companies that score well. So if you go look at our research team, Savita's and her team and Candace's team, have basically done the research that says if people score poorly on ESG, you can predict 90% of bankruptcies that way. ESG, environmental social governance, environmental being one is a little easier to find than some of the other things. So that's good research. Then that's causing investors to say, wait a second, if I can avoid the losers by watching these scores, by the way, you still have to produce returns and still do a great job for your clients. That's important input. So if you get the asset owners, the investors that manage the money for them, and the operators, and you get an agreement of what performance is, you're going to see more and more money. The whole entire capital base will start to align against this. Right now, ESG funds are growing faster in a big asset class, but they're still a relatively minor part of the total invested assets. If you actually get better alignment and a better agreement as the scorecards and less of them so people can actually do it, what will happen is all the money will start to go after it, because if the idea is you're going to have a long-term value proposition, it's better. Your employees are going to want to work for you. Society, your brand's going to be better. They should be investing long-term in this. It isn't proved that you outperform yet. We can't get that in the statistics. We can prove that you underperform and you don't follow it. And that is enough alone to start driving the money towards it.
We are marking a big anniversary for you.
Yep.
10 years in the job. Looking back at that 10 years, a lot has happened. A transformation of Bank of America, of the entire financial industry, a lot of the American economy. As you look back on that, what are you proudest of that you've accomplished, you and your team? Because you always say it was the team as well.
Well, if you think what the team did is we took, starting in 2010, sort of after the worst of the financial crisis and all the work we had to do, what I'm most proud of is actually what they did to drive the core business. Well, a lot of your colleagues and all of you are asking me about all the mortgage-related issues or the litigation of this. They drove the core business so that we have at the end of that, the business which are growing, business which are doing the best job they've ever done for customers, a brand in the best condition, and an ability to keep investing in that. That is kind of interesting, because in the middle of that, it's not like we didn't have some fun. We had market bounds of $21 billion in a quarter to take care of a lot of litigation, goodwill, and all that stuff. So it was some interesting times, but what they were able to do is keep driving the core business that gives us a platform. Really for the last 5 or 6 years, it's been just constantly improving it. And that is, it's taken us 200 years from the oldest part of the company to get to a point where all we have to do is think about doing a better job every day. And I'm proud of that. But most importantly, we did it the right way. We did it by managing risk right. We did it by never cutting our hiring, or never cutting our charitable budget, never cutting our volunteer hours. Even though we have less people, we still do 2 million hours. Driving our diversity program, driving down our healthcare costs and differentiating for highest paid to lowest paid by factors of 4 or 5 times now. And so nobody basically in keeping them flat for the people under $100,000 7 years out of 10, and for people under 50 forever. And these are things that we do. The $20 an hour next quarter. These are major things. So it's not only that they produced this and ended up with a good business, it's the way they did it. And the team did a great job.
Anniversaries are great things because you get to look back and you think what's going on. Because then they're artificial. I mean, you come into work the next day and you still get the same job. But as you look at it, are you looking toward a new chapter? I mean, you've accomplished that over the 10 years, or is it more of doing just the same at Bank of America? Are you thinking now it's time maybe we can pivot, we can go in a different direction in the second 10 years? Or is it more, you know what, we got it going pretty well, we'll just do more of the same?
Well, inherent in that is one of the questions I get asked often, but also one of the biggest concerns. There's no complacency in the management team, myself, and these teammates, that you're constantly transforming and changing the company. 10 years from now, the mobile banking, digital banking, the process automation, whatever will be so much different, and you have to be working on it all the time. But the basic architecture of the company, one of the great things I have that none of the predecessors that work for any of the companies that are part of this great company ever had, was all we can do is concentrate on organically driving the company every day. And so we can't do any deals because it's illegal. It has been for a long time. So our job is to get up and do it. So that sounds, you're not changing anything. You're changing the company massively at every day. And so we're deep in the question of operational excellence and how we improve every process and automate processes and get costs that doesn't do anything for the customers or teammates out. We're deep in the process of how do we think about new products and capabilities and integrating them in ways that we've never done. This, if you watch our online presence over the next several quarters, you'll see just this massive change to where it's moved over 2 or 3 years massively, but it's incremental because clients like to learn about it and make it work. And so those are the, Erica that wasn't there, now there. Zelle wasn't there, now is growing at 80, 90% a year and is taking off. The MEGI, the guided investments, $4 billion just crossed. These are major transformational changes. But if I said we have 8 lines of business and we're going to the customers, you're going to say, "Oh my God, he's not going to do anything. He's just going to sit there." The reality is underneath it, we're driving the company.
And finally, I mean, you don't like to talk about yourself, but I'm going to ask you to in this way. I first heard a great compliment to you from Warren Buffett, and it wasn't 10 years ago, it was probably 8 years ago, saying he's a really great banker.
Right.
What did he see in you, do you think?
Well, I think he saw that we had this, well, I know what he saw because he told me that when he made the investment. He saw this great franchise, and he just needed to give us more stability than we had in August of 11, when the U.S. was close to defaulting. And we think about these things like they're new things. In August 11, the United States, there was great question whether the debt ceiling was going to be up, whether we're going to default. There was huge questions about the stability of a lot of things out there. In the middle, we're getting knocked around, and so what he saw was a great underlying franchise that we just had to clear away the stuff, and then it would take off. And it's also a cash generation machine.
But he didn't say to me, Bank of America's a great franchise. He said, Brian Moynihan's a really good banker.
Well, because I think I don't. You'd have to ask him. But I think we recognize the power of what we're all working with, and what it can do for society, and what it can do for our teammates, and what it can do for our clients. And I never take that for granted. So this isn't about, this company will be here 200 more years, and the tenure of our management team will be a blip in the grand scheme of things. So we have to leave the wood pile with more wood on it than we came on, and I think he sees that's the attitude we have. You'd have to ask him.
So Brian, I know you're working with the World Economic Forum, particularly the IBC, the International Business Council, on the question of sort of social responsibility for corporations. What are you doing?
Well, first of all, just who it is that it's 130 or 40 of the largest companies and the CEOs. And so what we perceived is this whole move a number of years ago that we talked about with the BRT, which is to define capitalism more precisely and align it against the delivery of the Sustainable Development Goals for the UN. And so what we're trying to do, though, is those CEOs are confronted with lots of people and lots of measurement systems. So we're trying to bring the standards in around some key deliverables, key SDGs that apply in each industry, and 3 or 4 ways to measure it, and get everybody to agree from the people who invest in us and ourselves that if we make progress on that, you'll sort of give us credit and do it. That is a yeoman's work because there's literally hundreds and hundreds of measures, and we're trying to reconcile them so that we don't spend all our energy talking about the measures, we spend our energy making progress. So those are things like the environment, human capital, all the work you do with your teammates, and retraining and reskilling and education and hiring and how you pay them and benefits and healthcare, all those things. Is we're trying to get metrics that sort of show. So whether it's the just capital of the world, or whether it's the Sustainalytics, and whether it's the environmental measures, Bloomberg and Equality Index, which we're rated highly on, or the Bloomberg Environmental, you end up with all these metrics. We're trying to standardize them so we can spend more energy on delivering the SDGs than on debating which measurement system is the right one.
Can capitalism do it on its own? Suppose you come up with the standards. Do you need the regulators, like the SEC, to adopt those and make them enforceable, or can capitalism police itself in this regard?
I think you're going to need, policing's always a strong way to get something's going to go wrong. You need a endorsement of standardization, like you have with accounting standards, that is helpful, because then it doesn't look like. So there's a great debate out there. What's greenwashing and all this stuff? And I got asked once in a meeting, well, isn't that greenwashing? I said, what part of $300 billion is greenwashing? It's real money, and it's doing good things. And what you're trying to get people is to get away from that sort of, things. And the regulators can be helpful, saying, this is carbon neutral. This is, an acceptable use of terms of green bonds, by the way, which we have all agreed to a definition. So I think that standardization and a backup from the regulatory environment, not necessarily the SEC or anybody, is helpful, because when you get there, that then gives an outside stamp of approval. Plus, there's also credentialing, whether it's the rating agencies, whether it's organizations like yours, to say this is what we believe is standard, and do it is also good.